Hello, folks. 2 weeks ago, I laid out a simple but timely investment thesis that as we head into the 2026 midterm elections, incumbent politicians would propose policies that favor the what was then out of favor consumer stocks. What follows is an update. So, um, there we go. December 26, 2025. I made the video on consumer stocks and I laid out the investment thesis, the argument in favor of this investment opportunity. And what we have here is an update that summarizes a special basket of consumer stocks that I put together and tracked the results and compared the results to the S&P 500 over that period of time. And right here, as you can see, if you take the average of these discretionary type consumer stocks, it's up about 4.5%, whereas the S&P 500 is only up about 0.3%. Okay. So one of the things that I'd like to just mention about this, which to me is interesting and adds some additional support to this idea, is that if you do a little deep dive into these types of stocks and look at, for example, a stock like Hava, okay, um, Mediterranean, fast casual, Chipotle type of business model, you know, this I think is a classic example of a company that will benefit with additional discretionary income in people's pockets. We have the big, beautiful tax bill that has increase in standard deduction, and there's a number of things about the most recent tax bill that have just started to kick in as of January 1st. And if people have a little bit extra money in their pocket, they're going to, on the margin, trade from, for example, maybe eating, meals at home to being a little bit more inclined to eating out. And even in some situations, maybe trading up from like a McDonald's or a Taco Bell type of, dining experience up to a Cava, which is kind of a little bit more of a premium fast casual type of food products. So you can see that out of all of the companies in this basket of consumer stocks, Kava is the one that is up the most. And one thing that I want to mention is that we can thank for the whole universe of YouTube type of content creators for investments, opportunities, and I'm including myself now in that category. We should all thank a gentleman by the name of Burton Malkiel, who is an economist that back in the 1970s published a book called A Random Walk Down Wall Street. And I remember reading this book back in the late 80s. And every library that you went on and bookstore for when you looked up books on investing, this was always right there, and it was the most popular book, and it had tremendous influence on the investment industry. Okay, and basically, the premise of this book is that the stock market is completely efficient and it's impossible to beat the market averages. Okay, and his investment thesis is that stocks just take a random walk. They're just stock prices are just random fluctuations, and nobody can beat the market averages. And if it wasn't for him, then Wall Street would have continued to put a lot of effort into analyzing the fundamentals of companies, but instead what has happened is there's been a huge move towards indexing because of the influence of Burton Malkiel, and it's created this opportunity that for me has allowed me to increase my portfolio by about a factor of 15 over the years, and compared to about a tripling in the S&P 500. So whether he intended to have this influence or not, and the reason I bring this up is that just yesterday he I saw on Bloomberg television he was being interviewed and he was still in a sense promoting his book, and I was really surprised to see that Burton Malkiel is still flogging this book called A Random Walk Down Wall Street, even though the efficient market hypothesis has been, for all practical purposes, completely debunked. All right. So, my original points for the video from a couple weeks ago was that incumbent politicians know that they need to, in a sense, bolster the 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 well-being of voters, okay, and that they would favor policies that would stimulate the economy and inject money into the economy. I talked about, things like tariff dividend checks and stuff like that. But what we've seen actually has occurred is some variations on these themes. And recently, President Trump has proposed a 1 year, okay, interesting, just 1 year cap uh, of 10% on credit card rates. Okay. So I think it's really, really fascinating that this proposal is just for 1 year. It's almost like just until we get through the midterm elections, okay, we're going to cap the credit card. And obviously what that would do is it would in a sense, save consumers a little bit of money on their credit card bills, and then they would have a little bit of money left over, in order to buy stuff, okay? And so the banks are not happy about this, but the consumers would, and since you have a lot of potential voters out there that would benefit from this policy, then you could see that that kind of fits in with thesis A. Basically, we're talking about a transfer of economic resources from corporations to consumers if this were to occur. Big, beautiful spending bill. I talked about that. Um, I mentioned that the poor Fed Chair Jerome Powell is, really being attacked by the president, and this is unprecedented, really, at the level that we're at right now, because recently it was announced that the Justice Department, okay, has is investigating Fed Chair Jerome Powell for criminal activity related to the construction project on the Fed headquarters, and it's just like, okay, the attacks on Jerome Powell, who has been resisting lowering interest rates, just continue. So that does fit in with point C that I made in the video a few weeks ago. Um, Monetary stimulus is still happening because the quantitative easing is still going on. Tariff price increases, that's a long-term effect. Um, you know, there's also been this new proposal that there be a ban on corporate ownership of single-family housing. And in a sense, you can think of that what that would do is that it would and only about like 1% or so of residential housing is, owned by corporate entities. But if this ban were to take effect, then obviously you wouldn't have corporations in the market for buying houses, and it could, in a sense, free up a little on the margin. It could free up a little bit of supply of housing and put slightly downward pressure on house prices. And so you can also look at this as a transfer of uh, economic resources from corporations to consumers. So it seems like the big theme here so far in 2026 by the current administration is that we're going to temporarily, in a sense, kind of transfer some resources from corporations over to the consumer in order to stimulate the consumer side of the economy. And these things are helping to, in a sense, on the margin, that basket of consumer stocks that I talked about. So, 4.5% versus 1%, that doesn't look like a huge amount of money, but if you made 4.5% on your money every 2 weeks, within a few years, you might be one of the wealthiest people on planet Earth because that, 5 years or so. Because I mean, that 4.5% over 2 weeks is 9% every month. We're talking about over 100% annual returns if this were to continue. And once again, this investment thesis is really just a temporary type of investment play that I'm making and I expect it to be played out by say March, April, May, June in that time period, and then I plan on liquidating that small portion of my portfolio. So, anyways, just a little follow up on that. If you, I'm always fascinated to hear what people's comments are. Do you think that consumer stocks are going to be in favor in 2026? And do you think that these policies are going to continue to come out? Please feel free to comment. And as always, you need to, this is top of funnel. I'm just putting this idea out there for your consideration. So until next time, thanks and take care, everybody.